Hey everyone, hopefully you're having a good day. My name's Andy, channel's Finding Value. Today we're gonna rip through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go. It's generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive in there. Let's see what people are sharing, and I'll give you my financial opinion. If you want to follow me, it's at @finding_finance. And if you want to join our community, I do have a presentation I'm giving on the question and answer session with oil, and it's mainly oil driven and macro picture of what's going on with that. So go over to finding-value.com. We still have the LEAP coupon code still active if you'd like to join. 50% off the first month and only the first month if you're interested to try it out. Or you can get a yearly membership where it's a bigger discount. So coming on down, we've got, I think his name's Jorge here. Uh, EIA drilling productivity report. So this is your drilled but uncompleted wells. They can't keep this rate of decline much longer. So these are the Dukes, the drilled uncompleted wells total for the Bakken. You can see we're up here in 15, 16, and all the way in 19. And we've really drawn those down to very low levels. We're down to 323 for Bakken from seven. We were up at over 900 in 2020, 2019, 2020. And then Dukes for Eagleford back in 2019, almost in 2020, was 1,600, and now we're down to 352. So we've really depleted our drilled and uncompleted wells. And the way that I view this is that uh, future production is going to go down, supply. It's going to be tested, and we're going to have to drill a lot more wells to get back to where we need to be. And maybe that means higher prices, as maybe the price is too low, and that's why the drilled uncompleted wells have been depleted. So I'm looking at this drilled uncompleted wells. I'm seeing the Middle East having they've pulled back a little bit, just Saudi Arabia, but they're adding rigs like mad, which makes me think that they're probably pretty close to peak oil. If they're adding rigs and they're not really drilling that much more, they've communicated that they're going to cut back on production going forward. They were going to, at least Saudi was going to raise production up to, I think, 13 million barrels or something like that. They've pulled back and they said, maybe we can hold a steady 12. But they're adding rigs, which makes it kind of interesting, the whole setup here. Haynesville rigs, it fell 3 to 38, down 43% from a year ago. So the natural gas price is having an impact on how many rigs these guys are deploying. And that's going to have an impact on a lot of the energy service companies too. I think this is a really good setup because we've got oil that has depleted drilled uncompleted wells. And we're also pulling back on natural gas. This is the rig count here of evidence of that opinion, or fact, I should say. As everything kind of pulls back, we're not really deploying a ton of rigs in relationship to history. But if we have a wall of takeaway capacity coming in natural gas, and we haven't really kept pace with oil, well, then we're going to have a drilling boom in both oil and potentially natural gas at the same time. So I think that's a really good setup for energy service companies, in my opinion. Iron ore inventories are rising fast, now back at last year's level. So we were at very low levels for iron ore back in 2023, and they have increased quite a bit. So that will have an impact on the pricing of iron ore. And I'm just sharing this so you guys understand why the iron ore has been pulling back. Patrick says, daily defined run for Camco has ended almost 1 month ago. You had an opportunity to exit in strength a month before that. We are now in a correction which can be achieved with time and or price. So this is Camco's daily log chart. He's got a breakdown to the downside, and we've got another selling pressure bearish engulfing candlestick that's occurred. We've got a bear flag, which could easily end up in a larger correction to the downside, unfortunately. So just watch out. We could have further downside in a lot of these uranium companies still. Medium home prices are now contracting at levels never seen since 1964. The only thing I'll say here is this is the median home price, and that's not necessarily sales. This is the median sales price. What I see is I see a lot of people who want to buy homes, but they can't afford it. So what occurs is the people who can afford it are buying smaller homes, where the median home price will go down. It's also a function of lower sales too, because of the affordability. So I think interest rates are high. The affordability is not favorable for a lot of people. So the volume has really pulled back. But that doesn't necessarily mean that prices are going to fall. People are being priced out of the market, and there's this gigantic base of buyers that are basically underneath the market that are going to prop it up, in my opinion, if rates were to fall or prices were to fall, or both simultaneously. You've got that base of strength of buying pressure underneath it, in my opinion. Most of these other areas, we were in bubbles. 2008 was a bubble. We're not in a bubble today. Back in 1990, this was a bubble here where this recession is. We came back in that. We also had another bubble in the early 1970s and the mid 1970s as well, right here. So, and in the late 1980s or late 1970s, early 1980s. So these were all overbuilt situations. Overbuild, overbuild, overbuild. This was an overbuild situation. This was an overbuild situation. The only one that wasn't was this one. So right here was not an overbuilt situation, and we're not in an overbuilt situation. We do not have inventory levels that we're tripping over like we did in 2006, 7, and those previous recessions. I wanted to make sure that people know that. This is load growth history for electricity, and all indications are that we are inflecting higher. So this is the US grid growth. It's at a 5% CAGR in terms of its growth, and we are really ramping it here in terms of natural gas, wind, solar, hydro, and nuclear. Nat gas is in the yellow. That's the one that's really gaining the fastest of all these with good size. The fastest on a percentage term could easily be solar because you went from nothing to something. Wind's had a pretty good percentage gain too, and then nuclear has been relatively stable. I presented to large family office today explaining why I think gold is a must-have investment. The relationship between debt and interest rates has turned negative. More debt equals lower yields. Central banks are the cause of that, putting pressure on the relationship between fiat currency and trust as their balance sheets explode. Investors, people will look for other kinds of money, hard and scarce. Gold insurance premium value roughly equals 20% of the market cap of bonds. This makes gold big enough to have a shot of balancing out central bank balance sheets and debt. Bitcoin comes with many of the same characteristics, some better even, but its size and track record are smaller. Both are vital additions to your investment portfolio in this person's opinion. I like the chart where it's gold versus treasuries, the big outperformance of gold versus treasuries. And we have another large outperformance that is occurring right now. Gold just hit 2190, but the gold companies, are they more profitable? We talk about their margins and stuff. So all-in sustaining cost margins on average have been improving trend for miners. The all-in sustaining cost, that's the metric that matters for investors. Value investors will take notice, and you can see the global gold producing all-in sustaining cost margin has been increasing with time since 2012 all the way to 2024. The question then is, well, how come the gold stocks are so crappy? Because this sentiment, and they're still out of favor. I think at some point when gold continues to go on up and hopefully silver starts to engage too, that the miners basically start to re-engage. Somebody needs to tell Maverick to re-engage here, just like the miners. Base decline rates for various American oil and gas companies. So let me get this in. There we go. This is the 2024 estimated base decline rates, and some of these decline rates are 41%. Here's 30%, basically in the middle, 30%. And then anything below 30 is a lower decline rate. Anything above 30, I would say, is a higher decline rate. So I try to put my money in these over here, in a lot of these areas over here, versus the ones that are over on the right-hand side. I know a lot of people ask me questions about these ones on the right, and their charts aren't as good as some of the ones on the left. And this is a function also of heavy oil versus lighter oils. The lighter oils seem to have the bigger decline rates as these things age and mature. Some of the heavier stuff is very low decline, but it could also be a lot higher cost too. U.S. net natural gas exports set record weekly high this week. So they're exporting more to Mexico. So that's net LNG exports and exports to Mexico. So that's the entirety of it. We've got a lot more exports going on in nat gas. SRS Rock Report says, wow, world's largest silver mining company costs surge higher. I can honestly say that when I looked at Fresnillo 2023 year-end results, I was stunned by how much their silver mining costs increased. So it looks like some of the mining costs have increased for silver. Freight futures on the AM update, Capesize and Panamax are up 3% and 2%, while the tankers, VLCC is up and Suezmax is down 1%. A game of trades, we got bank credit is contracting only the second time in 50 years. The last time was around the financial crisis. This won't end well. And you know what? That very well could be the case. This is for bank credit in all commercial banks. Now, there's two things that create inflation in the system. One of it is bank credit, which is what we're looking at. All commercial banks and bank credit is contracting a little bit. On the other side is the fiscal spending and the deficits that occur from the interest rates, the interest expenses. So there's both of those things going on at the same time. And one is going to, I think fiscal is overpowering the monetary collapse here, which is the bank credit. This is monetary. Infin existing home sales data is especially bad again. It says home prices are up 5%. Ending home sales are down in terms of volume by 6%. This is going to be the story for the next decade. So it looks like we've got low inventories of existing homes. Sales have really slowed down due to the affordability. And I don't think a lot of people are selling because they may not be able to afford to move, so to speak. Why would you move to something that's more expensive and buy less potentially if you've got a low mortgage rate, or you own your house and you're going to move into something that might be more expensive where you might need a loan or some sort of case like that. But either way, median sales price is up 5.3% year over year. And this median sales price is the existing homes. The other one, I think, was of new homes that were being built that other guy was sharing. This is pending sales down 6% year over year. So sales are declining from a volume perspective. North Star, he's got a silver chart. He says also close to unleashing a much bigger move for the silver roadmap here. And I've been watching this one really well. This is your flag pattern and a potential break here. We haven't broken out yet, but man, we are getting close. And I think that the market conditions are very much aligned for a breakout to the upside. We have an inverted yield curve. When that curve generally uninverts, gold starts to run. Gold is running, and then silver is going to basically come behind it. So I think the opportunity is here, and I think it's basically right in front of us. So we could see a slowdown in the market. Tech stocks might slow down, and gold and silver start to rip it. And then the commodities will come behind it just after it. As said yesterday, First Majestic Silver versus NVIDIA is turning up on lower time frames. And today, NVIDIA has a big bearish engulfing reversal on daily after a very extended move. Looks like the historical turn for my AG to NVIDIA chart is right here. Big things are coming. This is a big fat bearish engulfing reversal after an extended move for NVIDIA. At the same time, you've got this big, this is First Majestic versus NVIDIA. And you can see a false breakout. This is going to be the biggest slingshot that I've ever seen for this. So there's opportunities in silver right in front of us, in my opinion. And I'll talk about those opportunities here during the question and answer session of what's come up this weekend and probably next weekend. I'll give you the whole lowdown on gold and silver and the whole setup, platinum and even palladium, the whole the four horsemen, the four horsemen of precious metals. Go over all of it. Gold investors having their way lately with mega cap tech investors who showed up late to the party. This is QQQ versus GLD. It's a tech stock versus gold. You can see the breakout to the downside. This is generally an indication of a potential peak in technology stocks and maybe even the overall stock market. Uranium is also trading potentially like technology stocks. And I made a comment, we need to watch technology because it could drag down a lot of our other investments with it. But gold is looking very good. Very, very good. Luke Roman, he says, in my opinion, an interesting bank run of sorts on our screens right now being shown by the black line below. So where is the gold tonnage going? Question mark. Why is the price of gold going up during this run on physical gold when it went down during 2013, 2016? So we've got a weird divergence here where the physical gold tonnage in the black here is diverging from gold itself. And you can see over time from 2005 onward that the ratio that they are selling their gold tonnage in relationship to gold, which is weird. Like, what is going on here? Is this a part of trying to tamper the price of gold down? So they're using GLD physical holdings to do it? I don't know. Or maybe people are selling their gold investments while gold price goes up. I doubt it, but maybe. Miners have just started their catch-up rally. So this is gold miners versus physical gold fund. We've been moving up the past few trading sessions. This is one to watch. If we might get a return, kind of a return move or a retest kind of move here, double bottom, whatever you want to call it. And then we might get a big surge. That if we get a double bottom, that's going to be a really good opportunity to be looking. The Baker Hughes natural gas rig count, active rigs fell by -4 rigs this week, the largest drop since November, and a third straight weekly decline. So here's your rig count. It's the blue line here, or blue, yeah, blue line, or blue, what do you want to call it? It has declined some. These are the declines in rigs right here, the total year-over-year change in rig count. That's a 22-year perfect bullish falling wedge. Even before I called the commodities bear market low back in 2020, I said platinum will outperform in the coming bull market. Dude, this wedge looks fantastic, guys. I'm all over this, guys. I love platinum. My boy Platty is what I call it. So here's platinum price, basically center that up a little bit. We got a nice big falling wedge, and it's really, really low right here. Probably a double bottom. We're probably going to break this at some point. When price for this ratio chart moves up, platinum outperforms gold. Platinum's cheap against all the metals, against gold, against palladium, and also against silver. Such a good opportunity. Robert Friedland, he's a big copper guy. He says UBS has tossed its hat into the copper ring with the bullish report saying copper supply crunch is unavoidable. The price forecast upgrades to 450 a pound next year, 475 a pound in 2026. The change of position was described as the bank pivoting towards a more constructive view on copper since the middle of last year. We know the market is closer to a fundamental inflection point. Bottom-up developments have been universally positive with material downgrades to 2024 mine production guidance, pointing to limited supply growth. Following material cuts to mine supply, we forecast a copper deficit in 2024, and a lack of new project approvals increases the probability of a protracted period of deficits, is what their opinion is of copper. Look at this base for Bitcoin. He thinks that's a base. We'll see. We'll see if it trades more like a technology stock or if it diverges. That will be an interesting thing to watch. And then Tavi says here, full-time employment is starting to roll over while part-time payrolls are rising substantially. This is reminiscent of prior recessionary periods. Although the anticipated decline in labor market conditions has been slower compared to previous cycles, there's now tangible evidence suggesting a significant deceleration in employment activity. The Fed is trapped and gold is sniffing this all week. Yeah, so this is the full time that's in the red rolling over while part time payrolls go up. We saw that at the tech bust. Part time goes up while we roll over. We saw that in the great financial rollover and this. We're seeing that today, and that might explain some of the weakness that we're seeing in the technology stocks, also in uranium and maybe even oil. This weakness will have an impact across the board that can impact all the pricing of assets. But that's where I'm gonna end it, guys. I think that's the last one. Oh, I've got here's another one. Oh, I've got two more. This is pretty compelling chart. Don't forget the rule: the bigger the base, the higher in space. This is only the very first week of the breakout from a huge base, and it's occurring very early in a new intermediate cycle. The other rule: breakouts that occur early in a cycle usually produce sustained moves. So we've got a breakout in gold and potentially a sustained move that's coming in Gary's opinion. And then we've got Tavi here, silver production from Mexico and Peru, the world's two largest producers, is at its lowest point in 14 years. The combined output is now down 25% from its 2016 peak levels. As gold breaks out to record levels, igniting a new bull market for precious metals, a major supply and demand mismatch is poised to drive silver prices significantly higher. This is the silver production, Mexico and Peru combined, and you can see this thing really low, the lowest in 14 years. And we've seen this before. Gold pulls back like this, silver pulls back, and then we generally get these gigantic runs in the precious metals. So the setup is there, guys. And are you brave enough to buy something that's out of favor? That's really the question. And then stick with it through this bull market that's coming. But that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you like. We still have LEAP as a coupon code. We've got a 5 p.m. Mountain Standard Time Sunday session coming up. I'd love to have you there. You can ask whatever questions you want. I will do a presentation in the beginning. I know you guys like getting all this information about all these different sectors, and I'll continue to do that. Next week, I'll probably dive deeper into gold, silver, platinum, palladium, give you guys the lowdown there. We can even talk about it in the second half with the companies if you guys are interested. We can dive into all the different companies, setups that I think that are out there in the future. And when I talk about these setups, I talk about the long, big picture view. This is the 30,000 foot view that the big underlying trends, like uranium, is a big underlying trend that's going to go up over time. But that doesn't mean we go straight up. We can have potential business cycle recessions that are inside of the bigger curve. So let's say we go up like this for the big long cycle. But in the short term, we're going to go up and down like this with market contractions, market slowdowns, and the fundamentals driving the price higher. It's going to be cantilevered up, upwards, going in an upward fashion, but we're going to be going up and down in the short term on an upward slant. What we call that, there's two different names. It's a secular bull market. That's a big bull market over a long period of time, maybe 15, 20, 30, 40 years. That's your secular trend. And then your cyclical, which is a shorter term cycle, goes up and down in the short term. So what we're seeing is we're seeing cyclical weakness in a secular strength bull market. So it's a cyclical pullback in a secular bull market trend. And that's where people can get confused. They think that if something is fundamentally strong, that it's just going to go straight up. It doesn't work like that, fortunately. And you have to ride through these market pullbacks and stuff if you're a long-term investor in a lot of these sectors. But that's what I've got for today. We'll catch you later. This is Finding Value.